A sharp recovery in the market after a tepid start following fears over possible tariff hikes by the US after Trump takes charge. Consumer durables and realty are the big drags, even as FMCG and energy manage some gains. The mid-caps are underperforming.
Zomato slips as rising competition in quick commerce pushes back margin expansion and drives a faster network rollout. Swiggy too feels the heat.
Dixon Technologies slides on profit-taking after an in-line quarter, and with growth expected to taper off, the managing director tells CNBC-TV18 that the FY25 revenue will top 40,000 crore and margins will start rising after FY26.
US President Donald Trump signs a flurry of executive orders after assuming office. He declares national emergency for energy and revokes the EV mandate, establishes DOGE and External Revenue Service, as well as pardons capital rioters. Also plans to impose tariffs of up to 25% for imports from Canada and Mexico. It's just the first half of trade, and we've had nearly 3 trading sessions worth excitement. From the highs, the Nifty first fell to the lows, and from the bottom of those lows, it has seen a bit of recovery. Are we still out of the woods? Perhaps not, but a lot of excitement is what we've seen in the first hour of trade, the first half of trade rather. I'm Mangla Malu, with me Hormaz Fatakia. As you see on the top of our screens, the frontline indices, the Nifty as well as the Sensex doing a lot better. The banking index, though off lows, is still under a wee bit of pressure, down almost 200 points. And the mid-caps is where the heat is. Still have about 1,500 stocks declining for about 900 stocks, which are advancing. But the story of the last 15 minutes, Hormaz, has been the big surge that we've seen in a lot of the heavyweights, and as a result of which the Nifty is back in the green.
You blink and you miss. Almost at one point, the Nifty was down 150 points. But take a look at that. In just the last 15 minutes, the index is up 250 points from the lows of the day. Again, nearing last week's high of 23,391. That is going to be the important level that the index will have to keep an eye out for. Of course, today's high is 23,426. So that is, they've already crossed that mark, but still the sustaining above those levels need to be the key. But of course, the mid-cap index is not recovering from the lows as much as the benchmark has. The index is still down 1%. And that is also because there have been some really extreme reactions when it comes to earnings. And 2 of those names are Zomato and Swiggy. Of course, Zomato seeing the post-earnings reaction in yesterday's session, and Swiggy bearing the brunt of that as well. Manglam, you have more data on that.
Well, just 3 things that really stood out from Zomato's commentary yesterday. The numbers not particularly bad. I mean, you did see an EBITDA decline and all of that and stuff, but 3 things from the management's comments that, spooked the street. The first one, of course, was on Blinkit, where they believe that losses will continue in the near term. This is a marked difference from what they had said a couple of quarters ago, where they are turning operational profit. So as a result of which they've brought forward their investments. Heightened quick commerce competition has led to a temporary pause in margin expansion. Most on the street were hoping for this growth to continue and then operating leverage to kick in as well. But now that margin expansion has been paused, and food delivery revenue, which was good from an operational standpoint, grew just 2% from a GOV basis quarter on quarter. That slowdown is largely because of the consumer sentiment weakness that we are seeing. As a result of which brokerages have cut their target as well. Jefferies is a hold rating and a target cut from 275 to 255. They believe that, aggressive Q-commerce expansion may force competition to follow suit and entry of new players to further add competition as well. CLSA, while they have a positive rating on the stock, high conviction outperform, they've cut their FY25-26 EPS estimates by 25 to 34% to reflect faster store rollout. And for FY27, they've raised the EPS forecast because the throughput would have increased as well. Nomura, they have a buy rating, 290 rupee target price. They're saying that strong execution and balance sheet are key positives in favor of Blinkit, but it is a good opportunity to accumulate given large TAM and likely market consolidation as per Bernstein. That's about Zomato. Now, if you look at both the intraday charts of Swiggy and Zomato, you would see that once Zomato fell, Swiggy felt the heat as well. So if you look at the intraday charts, side by side, Zomato recovered from the lows, Swiggy is still recovering from the lows. Why is this important? Because Zomato's weak performance, weak commentary around quick commerce has impacted Swiggy. Secondly, since Swiggy's IPO, the valuation gap between the two has narrowed. So if you look at just, the Swiggy and Zomato valuation discount itself, Swiggy, when it came out of the IPO, issue price at 390 rupees, the peak, the discount versus Zomato's valuation was 65%. At peak, that discount has actually narrowed to almost 32 to 35%, depending on the multiple that you're giving to it. And now the discount between Swiggy and Zomato is around 50%. So at what rate does this settle is another variable that we'll be looking at. When Swiggy was offered at IPO price, the discount versus Zomato's valuation 65. Then Swiggy moved higher, Zomato moved lower. Swiggy was at one point above 600 rupees per share as well. That time the discount between Swiggy and Zomato was close to around 35% itself. And now Swiggy too has fallen off highs, Zomato has fallen as well. The discount has widened once again to 50%.
You know, the other similarity is the fact that Swiggy's post-listing high, as you mentioned, 617 rupees. The stock is off 30% from that. Zomato's high, 304 at the day's low. That too is down 30% from its peak. So both of them moving in tandem is Zomato and Swiggy bearing the brunt of the results. Now, the other extreme earnings reaction in today's session is MCX, and that is also following its third quarter earnings. And Vamakshi is now joining in with more details on that. Vamakshi, what led to this fall in MCX?
Well, Hormaz, growth has slowed down on a quarter-on-quarter basis in the company. If you remember, in quarter 2 of FY25, the growth was in double digits. Now that has significantly slowed down, and growth this time around is only in single digits. When we look at the revenue, that has seen an uptick of only 6% sequentially. EBITDA is up 8%, net profit is up only 4%, and the margins too have improved by 125 basis points. Although this is an improvement when we compare it to the improvement that we saw in the previous quarter, which was nearly 600 basis points, this seems rather tepid. When we look at the key internals as well, traded clients stood at 6.9 lakhs. This is an uptick of 1.5%. The growth last time around was also much better than this. The average daily turnover for both the futures as well as the option segment saw an uptick of 6.9%, and this growth is largely being led by the option segment. Market share was more or less stable. It was at 97.84% in quarter 2 of FY25. It has improved to 97.97%. So overall, when we look at the results that came in from MCX, not a great set. There's another note that came in from Morgan Stanley on the company. They have an underweight call with a target price of 3,715 rupees per share, and they say that core EBITDA was more or less in line. A higher SGF, which is the statutory guarantee fund contribution, caused the miss on the net profit. They also said that there has been stagnation or moderation in average daily revenue in recent months, and if this sustains, they could see some significant derating. They find the current valuation stretched given the low conviction on sustainability of revenues, which carry significant concentration risk. So Morgan Stanley too expressing some caution on this counter.
Right, that's about MCX. A big decline is what we're seeing on that one as well. Meanwhile, the Nifty still continues to hold with the mild green gains itself. So good time to get in our growth code, the initiative that we've seen. Actually, as we speak, the Nifty's recovery has been sold as well. When we started the show, it was up 40 points. Now it's down about 45 points. So it's all happening, Hormaz. It's all happening.
Make comments at your own risk. As of now, the moment you finish a sentence, the index is turning. But of course, going into growth code to make you well-informed trading decisions. This week, pro trader Rajesh Baheti, the managing director at Crosseas Capital Services, gave his insights on the new SEBI guidelines for algorithmic trading.
So currently, there is no real regulation as such that debars anybody from trading in algorithms or using algorithmic trading. What is happening is there are two kinds of algorithmic trading strategies that are being deployed today. On the professional or prop side, as what we do, all of our algorithms are approved by the exchange. The trades are entered as algorithmic trades. There's an identifier in the order sequence that identifies the trade as an algorithm. What is happening with the discount brokerages is that they are exposing their APIs, and anybody with access to that API can either write their own code, or there are some pre-authorized vendors who have already matched their trading strategies to these APIs, and they are farming it out to the retail public. And these trades typically don't get registered in terms of an order identified as an algo trade, but rather as a standard internet trade. And I think SEBI has a problem with that. They don't want the algo trades to be identified as standard internet-based trades. They want the algo trades to be identified as algo trades even for this retail segment. who are currently coming in using the APIs exposed by developers. What SEBI wants to do is that if you want to run an algorithmic strategy and you want to write your own code, then you've got to get that thing certified with the exchange. The strategy has to be approved. And in case you are outsourcing it from certain vendors, those vendors will need to get registered as some kind of investment advisors.
Hello and welcome to our continuing coverage here from Davos 2025. It's bright and early on day 3 of our coverage here. And joining me now is a man who actually started his tenure as CEO of MD and CEO of Tech Mahindra right here with us in Davos with his first interview. Mohit Joshi, it's great to have you back here on CNBC-TV18. Thanks very much for your time. You're fresh off your Q3 numbers and a good quarter coming in there for Tech Mahindra, Mohit. But let me start by asking you, it's been a year exactly now for you in office. A long year, I would imagine, but where do you find yourself on your turnaround plan that you had comprehensively detailed here in our last interview?
Right. Well, thank you, Shirin. I think it's wonderful to be back here. And thankfully, it's not as cold as it usually is in Davos, so a little bit of relief there. Like you said, in December, I completed 1 year as the CEO of Tech Mahindra. And it's been a fabulous journey, right? I think we packed a lot into the first year. Started of the year actually on the 1st of January with the new organization structure. Within a couple of months, we figured out our new strategic narrative, which is scale at speed, the only player that can give you the benefits of scale, but also the benefits of agility. We followed that up in April with a detailed Capital Markets Day presentation about a plan for revenue, a plan for margins, and a plan for the organization. And I think the plan was very well received by, by our employees, by the markets, by our clients. And since then, we've been on this journey of steadily showing improvement from a revenue perspective, from a margin perspective, and from a large deals perspective. So again, this is a multi-year journey that we're on to excellence. But I feel quite happy about where we are on the journey. As I had said in my earnings release, sort of paraphrasing the Spotify CEO, that we are where we expected to be on the transformation journey, if not a little bit ahead.
Okay, so that's important that you are a little bit ahead. But reacting to the results, I've been looking at what analysts are saying at this point in time, and everybody acknowledges the fact that it has been a good quarter. But they say that now it's only going to get harder from here on. So the heavy lifting, so to speak, will have to be done from here. So Mohit, what will you prioritize? And let's talk about margins, for instance. The estimates are just short of 15% at this point. Do you believe that you could do better? Are you closer to being able to achieve that number?
So look, I think, the second year obviously is, the first year was the year of the turnaround, right? And we're still in the first year till the end of March. And where we said there would be a degree of volatility in our earnings. The second year we said is some of the results of what we have done, right? Look, the new organization structure that we put into place, the new focus that we have on, maintaining our supremacy in telecom and manufacturing, but also growing BFSI and healthcare and retail and energy. And the results that we have from the focus on our top accounts. These will start to bear fruit, hopefully helped by a better macro situation as well in the next year. We're not expecting any overnight miracles. We had not promised any overnight miracles.
No, you promised a 3-year turnaround plan.
We promised a 3-year turnaround, and look, we are well on the journey. The way I think about it, right, is that this is like planting a garden, right? We designed the garden, we shared with the investors, they liked the design. We got in a new team of gardeners, we've got all the infrastructure in place in terms of the watering and the feeding of the plants. But equally, if I'm tempted to tear every plant by the root every day to see how they're growing, it's not going to go very far. So I think what is needed over here is what is needed in life, right? Faith and patience.
Well, since you're going with the garden analogy, let me continue. So the green shoot starting to bloom now, is that what you're seeing?
Very much. So I think, I feel that we've had 3 quarters now of consistent improvement in revenues, consistent improvement in margins, and consistent progress in large deals, right? The relevance to our clients is increasing. Our visibility as a brand is increasing. As you mentioned, for the first time, Tech Mahindra has a significant presence on the promenade
here in Davos.
In Davos. our sponsorship of the Global Chess League or Formula E. So we're doing a lot of things to, to get that client relevance and to be able to, apart from obviously showing the growth in margins and revenue.
You didn't answer the margin question.
On the margin question,
though.
so look, if you look at it, right, just in the last quarter, our margins went up from 9.6 to 10.2, right? So 60 basis point expansion in margins, despite a 70 basis point headwind from FX, right? So I think this should give the market confidence that we will hit the 15 number in FY27. We're obviously very committed to it. We have a clear plan. I think we have a wonderful team with our Chief Operating Officer Atul Suneja, our CFO Rohit, our CHRO, all of the SBU heads. So I feel that we have a very clear plan of what can be done. And again, everybody else is, running at those margins. So it's not like we're shooting for the moon.
Yeah, well, let's talk about the environment and the external environment in light of the commentary that's come in from President Trump overnight and what is expected. What did you make of what you heard from President Trump, as well as the proposed measures which have not yet been announced?
Yeah. So look, I think that a lot of the moves had already been telegraphed well in advance, right? And I feel a lot of the focus obviously is on the immigration issue, on birthright citizenships, things that maybe do not impact us from a business perspective. I think it's very clear, given the people that President Trump has surrounded himself with, that he's a deep believer in technology, right? And the power of technology. That was the front row. Yes, the power of technology to, to transform lives and to transform the American economy. The U.S. is a very large market for us, right? It is our largest market, but we also have a presence across the world. So I think the business sector in the U.S. certainly feels optimistic about the lower regulatory pressure, the greater focus on technology. And I think all of that should be a net positive for our business as confidence comes back. And enterprise tech spending is really a key driver of the U.S. economy. So we feel confident it should remain strong. So
24 was better than 23, 25 likely to be better than 24 for you?
For sure, for sure. And all culminating in FY27, which is where we've given the our grand plan for. So no, I do feel that, look, 23 was very difficult, right? If you look at it from a tech-M perspective, we shrank by about 5% or so for the financial year ending on the 31st of March 24. For the current year, we've shown growth quarter over quarter in the past couple of quarters, and I feel confident that calendar year 25 should be a strong year. A strong year. Again, not a breakout year, but a strong year.
You're being measured there as far as your outlook is concerned. But Mohit, let's talk about what you're seeing as far as the telecom space is concerned. You did call out the fact that while things haven't gotten worse, they're not getting any better either, and that's 30% of your revenue. So how do you de-risk yourself in that sense?
Sure. So look, I think it's not really a question of de-risking per se. We want to make sure that we remain the most relevant for telecom players across the world, because almost uniquely, right, both on the IT side as well as on the network side, we have a unique set of capabilities. We can help operators sort of simplify, modernize, and monetize their estate. If you look at the most recent quarter, for instance, right, a lot of the large deals that we announced, including autonomous network operations for a European telco, a large deal again with a European telco, and then a deal with a North America telco from a customer service perspective. We are seeing a lot of deal momentum from a telco perspective. Obviously, the situation for telcos remains a little bit tight, right, in the sense of reduction in capex and huge pressures. But this is where I think a player like us can make a difference. So we do feel that we will see a lot of consolidation and cost plays. Again, I also feel that the regulators have come to realize now, or have realized, that they have maybe put too many burdens on the industry. As we saw in the UK, for instance, with the acquisition, with the takeover of Hutch and 3 being agreed. We do feel that the regulatory pressures on the telco business will ease.
And some government intervention is likely?
I think it should. Look, I think it won't be intervention as much as easing up from a regulatory perspective. And if you look at it, right, if you look at the US telcos, for instance, the stocks have really done well over the past 1 year, which also reflects, I think, a confidence in the long-term potential of the sector.
Let's talk about deals, because you've, as you pointed out, you've done well both quarter on quarter as well as year on year as far as deals are concerned. What's the pipeline looking like, and what do you intend to focus on when we talk about going after deals in 25?
Sure. So if you look at our large deal sort of wins, right, it's actually been a very steady trajectory from a 300 odd number to a 400 to a 500 to a 600, and the most recent quarter 745 million in large deals. We have always said that we will be very selective in large deals and we don't want to trade margins for growth. Our focus is very much on meeting the margin.
Is it getting even more competitive in that space?
It is more competitive, but look, I feel that at the end of the day, the solution quality, right? The solution quality, the people that you bring on board is very important. And this is where I feel that we have an edge in Tech Mahindra. If you think about our workforce, for instance, the average sort of experience of our workforce is 9 to 10 years. The average experience of the workforce from our peer group is about 3 to 4 years, right? And I think clients have started to realize that the experienced workforce that we bring to the table really is a game changer for them. We've also gotten certain service lines where we have unique strengths coming both from the MBT heritage and the Satyam heritage. So engineering, for instance, digital enterprise applications includes SAP, ServiceNow, Oracle, Salesforce, our business in data and AI. And we're really looking to double down on these to generate growth, apart from obviously our historic strengths in BPS.
So let me talk about doubling down on both data and AI, which is the bet that everybody is making at this point in time. So what's the kind of spends on AI and building out those capabilities? And how do you differentiate yourself in a market where everyone wants to be everything for everybody when it comes to AI?
Yes, I think if I had $1 for every AI house I've seen on the promenade.
I have a video of it. I made one.
Yes, everything is AI or AI led. Yeah, you're right. Look, it is a breakthrough trend, right? So no wonder people are trying to stick onto it. The way I think about AI actually is far more basic, right? In the sense that we have to create the vertical and the horizontal use cases for customers. So the horizontal use cases, for instance, are in marketing, in cybersecurity, in HR, in contact center transformation. And the vertical use cases are by industry, right? You know, fraud and anti-money laundering for banking, energy consumption and reducing churn for telecoms, right? So we've got these horizontal and vertical use cases. Then we have the ecosystem partnership with the hyperscalers, with the AI model builders, and we have our own R&D, right? I think uniquely among the SIs, we have built a large language model for Hindi, from scratch, right? And partnering with NVIDIA, we built a large language model for Bahasa Indonesian.
Okay.
And while these are not models that we have monetized to a great degree, I think it gives a lot of confidence that if a company can build a model from scratch, they probably know a little bit more than just building an AI house.
I hope so. But what does that mean eventually as far as business is concerned, Mohit? I mean, when does it start to make a significant difference, an incremental difference as far as numbers go for you?
I think what we're telling our clients is, look, candidly, a lot of the spending on AI has not gone to the system integrators, right? Has not gone to the service providers. A lot of the spending on AI has gone towards the hardware and towards the software place, right? I feel clients are realizing that they also need to be able to simplify their data estate, to modernize their application infrastructure, to really take advantage of AI. And I do feel that in 2025, some of the momentum will shift from the hardware and the software play towards more of a services play, because at the end of the day, if you don't have a data estate which is clean, if you don't have applications that can consume AI services, you can invest as much as you want in AI models, right? It's not going to help. The analogy I give, right, is like we already had a car that went from 0 to 100 in 10 seconds. Now with AI, you've got a car that can go from 0 to 100 in 2 seconds. But if you don't have the roads infrastructure, if you don't have the lighting, if you don't have the instrumentation, that car is quite useless, right? So I feel that in 2025, a lot of the investment will go towards simplifying and modernizing the estate. I think the thing is, for enterprise clients, a lot of the technology is really ancient, right? A lot of the banks, a lot of the telcos are running on technology that was written in the 70s and the 80s. So there is a huge need to modernize this estate, to simplify this estate, to really get the benefit of AI.
So in an AI era, from an Indian IT services standpoint, I mean, double-digit growth rates, is that something that we should be looking at, optimistic and hopeful of?
I think we should be hopeful about it, but
how realistic? How realistic
I think
is it?
in 2025, double-digit growth is a little bit of a stretch. Right now, again, things could change very quickly. I do feel that for the next year after that, because these things always build up, right? Unless you take a year like COVID, when things went to the moon directly, it always takes a little bit of building on, because at the end of the day, increasing IT spend also requires a huge amount of effort to be able to consume it. So I do feel that 2025 will be the year of consolidation, and then 2026 will hopefully be the year of explosive growth.
2026 will be the year of explosive growth. That's quite a statement.
Of faster growth, for sure. Because
Okay.
I do feel that a lot of the investments in simplification, in modernization, a lot of the estates still have to move to the cloud, the data modernization initiatives, these should pick up. And so if not explosive, at least close to double-digit growth.
Close to double-digit growth in 2026. So are you looking at M&A at this point in time at all, or is it largely going to be driven by organic growth?
I think our focus just now is largely organic. We may look at small tuck-in acquisitions, but we're very focused on integrating what we have acquired in the past, but really very focused on organic growth, right, on our largest customers and our largest sectors.
Let me end by asking you, Mohit, since the current debate is on what happens to the workforce, what happens to workflow, how many hours do we need to put in, and how do you look at this, and how are you reorganizing workflow as well as the workforce in an era of automation and AI and generative AI?
So look, I do feel that as far as the workforce is concerned, as far as sheer numbers are concerned, I do feel that the human element will continue to remain predominant, forever, right? And the analogy that I gave is if you look at contact centers, right, which have been influenced the most by automation, we've had multiple waves of technology interventions as far as contact centers are concerned. So we had first, interactive voice response units.
Yeah.
We had the first generation of chatbots. We had the internet, right? Self-service on the internet was supposed to get rid of the contact center. Then we had the second generation of smart chatbots. But yet in this time frame, in 2000, you had about 4 or 5 million contact center agents, and now we have 17. So in a sector that has seen the most amount of technology intervention, you've seen a huge growth in the labor force because global economies have grown, because more people have phones, because people are consuming more things. So I remain quite optimistic about the overall potential from a professional services perspective for employment growth. As far as the second issue of how much you should work, right? My own sense is twofold, right? One is you have to work as much as is needed, right?
Yeah.
Sometimes you can't always have your pedal on the metal.
Yeah.
I also almost uniquely feel that for senior people, right? For people like me, unfortunately our weekends are not sacrosanct, right?
Yeah.
Sometimes you end up traveling on a weekend, sometimes you end up taking a call on the weekend.
Yeah.
But as far as possible, we have to model those behaviors so that we're making time for our families, we're making time for our own interest, because the tone from the top is quite important here.
No, absolutely. The tone from the top makes a world of a difference, and the hours you put in have to be seen in context of what the job entails as well.
Exactly, and I've got a 14-year-old and an 11-year-old, right? So don't want to be missing out on their lives almost completely.
And you shouldn't have to do that. Mohit, before I let you go, a final headline for 2025 as far as Tech Mahindra is concerned?
I think for Tech Mahindra, the headline is always the same, onwards and upwards.
Onwards and upwards. We wish you the very best of luck. Thanks very much for joining us here in Davos on CNBC-TV18, and we look forward to hearing much more from you. That's Tech Mahindra's Mohit Joshi. The turnaround plan that he had articulated here on CNBC-TV18 exactly a year ago, currently underway. It continues to be work in progress. Things have made a turn, and the acceleration process is now underway. 2026 likely to be an explosive year, in his words, for the IT industry. We are going to take a break with the conversations continue. Don't go anywhere. We're back in a moment with more.
Welcome back. You're watching us here on Halftime Report. Now, this is the time where we take note of the F&O action in the market. And typically, I walk across to that wall and do it from there. But today, I didn't. The reason for that was because from the time I could walk from here to that wall, maybe the market changes. Because that's exactly what happened. You look at the way the market has moved today. It was, all the way down from thereafter. There was this big up move that we saw at the start of the show. And that recovery was swiftly sold into. Too early to call anything currently. We're back at the low point of today's trading session. Put that, hump behind us, so to say. So it is back to square one. Sharp fall in the markets once again. So the Nifty Bank, the mid-cap index, all of them under pressure. The mid-cap index back below that 1.5% sort of mark right now, 1.7% lower. And the broader market pain widens once again. So if you look at the intraday charts of, the crisscross lines, you would notice that they tried to come closer to each other, but thereafter swiftly moved apart as well, with the red line now much above the green line by virtue of 1,800 stocks, the green line seeing just 650 stocks in the green. India VIX, that's the one that is spiking, because when everything goes up and down, it's the volatility which increases, and it's likely to increase further as we move towards the budget. What's happened in the options data? Just look at that. First up, when the market was falling. It was the put writers which actually got caught on the wrong side. Thereafter, there was a swift recovery, taking all those call writers out as well. And now you have the 23,200 call, which is back again fairly active, 23,300 call back again active. And it's just not this price that tells you the story of the day. It's the range of the day that tells you the story. 23,400 call, for instance, currently is 129 rupees. At one point, it was just about 100 rupees. And at one point, it was up 500 rupees as well. We're seeing some writing on the 23,150 put. Let's see whether we see support around the 2370 or 2380 odd, or closer to 23,100 itself or not. The one stock that I'm watching out for in particular is Dixon Tech. It will enter F&O ban after the big decline and the big surge in open interest that we've seen. So just keep an eye out on this. For the market, I think the only thing to say is it's a roller coaster, not just any roller coaster. It's the one that, one of those steepest increases and decline sort of space that we've seen today.
Not for the faint-hearted. Do not try this at home. You can put out every disclaimer possible. Looking at this intraday chart, it just took me back to my school days when we used to have this saying called "Bakri chadi pahad par and then dusri taraf se utar gayi," and it's almost reminiscent of that.
I don't know what school you went to.
But that's the story of the index so far. 23,100 now remains the key level on the downside to defend. Take a short break. More on the markets on the other side. Stay tuned. Back with us here on Halftime Report. 200 points down on the index. At least now that hasn't changed in the 5 minutes that we took a break on. Still at 23,150 is the Nifty. Some casualties apart from Dixon Technologies in the broader markets is Nugent Software, and that reported results yesterday during market hours, and that stock is down 17.5% in today's trading session. So a big drop there coming in for Nugent Software at the lowest point of the day at 1300 now is Nugent Software. What is also extending its losses in today's session is Oberoi Realty. And you mentioned about the fact that these two real estate names that reported results are moving in opposite directions. Oberoi Realty is on the downside, 7.5%, almost 8% down now on the stock. But on the flip side, what's doing well is Suntec Realty, and that stock at one point was up almost 5 to 6%. At one point it even gained 9%, still off the highs of the day, holding on to gains of around about 2.5%. Paytm has recovered slightly from the lows of the day, still trading with losses of around 5%, but at one point had declined almost 7 to 8% post its results that were reported in yesterday's trading session. So 5.5% lower on Paytm. And Vodafone Idea, after yesterday's 8% surge in yesterday's trading session on the AGR matters and a lot of other issues, is also seeing some bit of profit booking, if there was some, in yesterday's trading session. So 5% lower there on Vodafone Idea as well.
I'm just looking at Kalyan Jewellers once again. It's down 6% now, fallen below the 500 mark as well. Remember, on Friday it fell below the mark at which the promoters bought, and at the stake at which the promoters stake was, the price at which the promoters stake was pledged. And yesterday we got a notification on the exchanges that promoters have had to, by virtue of the big decline in price, increase the pledged stake by a few crore shares thereafter as well, over and above what has already been pledged. So the stock has now seen further pressure, now below the 500 mark as well. And from here on, every incremental sell-off that we see on Kalyan Jewellers, the promoters will have to shell out some more stake in increasing their pledge as well, or supporting the pledge which is there as well. So then this becomes a bit of a spiral. So we'll have to watch out for how this pans out. The earlier it, the company comes out of it, the better it is, because we've seen a lot of companies where a lot of pledge keeps getting accumulated with a decline in share prices, then everyone's hands are tied. So the sooner the company goes ahead and, revokes the pledge on that or arranges funds to do that, is the time when we'll probably see some sort of improvement here itself. Let's move on. Let's go across back to Davos. Shireen is with us from the World Economic Forum in Davos, where she's joined by K. Kritivasan, the CEO and MD at TCS. Shireen, take it over.
Our conversations continue here in Davos, and it's a flurry of tech companies that you're watching here on CNBC-TV18. You just heard from Tech Mahindra's Mohit Joshi on why he believes that 26 could be a year where the IT industry could see, in his words, explosive growth. Well, joining me now to talk about the outlook, not for the next quarter, because you've heard that being done threadbare on the channel, is K. Krithivasan of TCS. Krithi, thank you so much for joining us here on a very cold and early morning in Davos. If only AI could fix this.
Absolutely, absolutely, it will be fantastic.
So Krithi, as I said, to the last decimal point, your numbers have been discussed over the performance for the quarter. But let me ask you a more big picture question.
Sure.
When we last spoke here, Krithi, you had said that your effort was going to be to bring the engineering culture back at TCS. A year and a half on, do you believe that the engineering culture is back?
See, we have made a lot of progress. It's not that, as I explained last year also, it's not that we had lost it, but we wanted to re-emphasize the engineering culture. And it also fits in very well with the way world is going towards generative AI. And we have made more than 500,000 people trained on generative AI. We have made investments in tools like Wisdom Next. So I believe that we are moving in the right direction.
Moving in the right direction. Since you talked about AI, and your slogan here in Davos on your lounge says TCS, the perpetually adaptive enterprise. Explain to us what that means in terms of strategy.
First, let me explain what we mean by that. Like, for us, there is so much of change happening in the world, be it in the climate, geopolitics, new technology coming in, supply chain disruption. And we believe any organization to be successful, they need to adapt continuously. And they have to adapt in terms of what they sell in the market, how they train their workforce, and how they interact with that supply chain. And within TCS, our approach towards this is coming up with newer solutions, newer offerings to our customers, continuously looking at what our customers need. And equally important is continuously training our workforce, because we believe with generative AI becoming more and more mainstream, the role of a programmer will continuously shift. If today we have 100 programmers doing a set of activity, maybe we will not need 100 programmers, but we will need more people that will be training the models, somebody orchestrating all the models to deliver the value for the activity. So there is a lot of training going on.
Right. No, so when you say that you won't need 100 programmers, I'm asking you this in the context of the absolute numbers. You may not need 100 programmers, but do you see the headcount changing dramatically?
That we've been saying again and again.
Yeah.
Like, our belief on this technology, like the previous waves of technology changes, is the number of people that we need will not come down. But what these people will do will change. That's where the adaptive enterprise come into place. People have to learn new skills, develop new capabilities in terms of how do you work with these generative AI models, and deliver the end-to-end solution to our customers.
So it'll be more from the same. That is the expectation?
It's definitely more from the same. Maybe even our going in belief is we'll end up having more people than what we have.
More people?
More people, actually.
Okay.
Because the quantum of work that will be delivered will be much more than what is being delivered.
So more people over what time? What does that mean in terms of hiring?
I don't want to put a timeline to it, because it's over a period of time. But I don't think we are fearing the reduction in amount of people required to do that. Like, we are gearing up to have more people do the work.
Gearing up to have more people, that's an important headline coming in here from K. Krithivasan of TCS. More people, not less, in an AI world, in an AI era. Krithi, what surprised many people was the fact that you actually called out 25 to be a better year than 24, which is not usually the case as far as TCS is concerned, given that you don't hold out any guidance. What gives you confidence to say that the year ahead is likely to be better?
The most important thing is the conversations that we are having with our customers. And the second, as we talked about, is our order book and the pipeline. And all of them put together, collectively, we believe that there is a sense of optimism slowly coming back to our customers. And we also saw a couple of things like some of the discretionary programs are getting kicked off. And most importantly, the in some of the discretionary program, the time taken to decide, that the deal cycle also reduced. So all of them collectively give us a feeling that this could be 25. So 25 could be a better year than I'm sorry.
Then 24.
CY25 will be a better year.
I wonder if you were up at night watching President Trump and what he had to say, but what's the outlook on what that could mean, especially on the part of the measures for deregulation, which of course are yet to be specified, but what could that potentially mean, especially for the financial sector, because there is talk about specific deregulation there too.
There is definitely a lot of optimism in the financial service sector, because regulation takes away a lot of the management bandwidth, and also certain amount of allocation of funds towards new programs. So be it the financial services sector, maybe sometime later even in the healthcare sector, we believe that it could actually spin off new interesting discretionary programs that they have not been able to do before. So it's net positive. Like most of the banks that I've been talking to, they are very optimistic on the things to come.
So banks are optimistic on what deregulation could mean, and healthcare as well?
Healthcare had to wait and watch, more cautious. We had to wait and watch because we don't know what they are going to do, but general atmosphere of deregulation is being seen very positive.
And you believe that that could have a spin-off impact as far as discretionary spends are concerned?
That will definitely have an impact. Positive impact.
Positive impact. Let's continue to talk about AI, and you were talking about the capacity and capability building within TCS. And you know, I was having a conversation with Frank D'Souza, formerly of Cognizant here in Davos, and his belief was that Indian IT services is at an inflection point or in a transition period where it will have to be much more IP driven. Now, in a man-hours business, so to speak, as somebody commented on that interview, what role does IP really play?
It does. See, like it has a very important role to play. Like for instance, but only thing is, like, IP should not be classified only as someone having a new LLM or a new product. Like for instance, in TCS, if you take, we continuously apply for patents. Okay, and these patents are leveraged to develop our products and services. But we there is time. I think it's also a question of time, Shirin. Like we have over a period of last 20 years, we have developed the capability. You find many new startups coming up with new IP, new apps. I think it's an important thing to focus on, and every organization is focused on developing IP. So see, IP, the value it gives is it breaks that linearity, right? Like without IP, pure services, there is a certain amount of linearity between how many people you put and what is the overall.
So will that be a focus area for you over the next few years? Is that what
that will be one of the focus areas. Like, I'm not saying we'll be focused only on IP. We'll be continuing to create IP, but that will be one of the key focus areas, definitely.
So, you know, as part of this transition that everyone's talking about, what do you see as being the key changes to the model, to the operating model per se?
In terms of AI coming in?
AI coming in, you know, the world changing, so to speak, and more fierce, intense competition.
No, like I don't see a major model change. The change would happen in terms of, as I said, how do you train the people, what do you train them on, and how do you recruit them, what capabilities you look for. Those are the areas I think major change happening. Otherwise, the broad model, I don't expect the immediate change at this time.
So what have been the efficiency gains for TCS on account of what you've been able to do with generative AI so far?
See, we have seen a large number of, from a software engineering perspective, we have done number of POCs, we have done number of experimentations. Our experience is between 5 to 25%, depending on the kind of technology they employ, kind of maturity the organization has. Between 5 to 25% is what we have seen.
But is it now moving from experimentation to scale?
It is moving from experimentation to scale. And we are also developing our own platform. For instance, we created a platform called Wisdom Next. Wisdom Next helps our customers to evaluate multiple LLMs under different contexts and decide which LLM they should be using for a particular kind of query they may have, and also let them choose what is the budget they want to spend, because this is not going to come free. We are going to pay for the number of tokens you use, right? So it lets them choose which is the most economic or the optimal LLM to use for a different context. So it helps the organizations do that. So you see a lot of value from it.
So, if I were to ask you about the possibility and the doability of achieving double-digit growth rates as far as industry is concerned, and I know you've been asked this previously as well, but
we continue to stay it's a definitely an aspiration for us. We don't believe that it's an improbable number. We believe it's definitely possible.
By when?
I don't want to put a timeline. But we constantly aspire for this. So if you ask me, do I want to...
Is it within reach?
It is. Like, see, look at the other way. Like when I took over like or for many years we've been talking about a margin side. We keep saying 26 to 28. In Q4 of last year, we did achieve 26. Again, we slipped. But it is something that's possible within our grasp. Similarly, a double-digit growth, I don't think is improbable. That can be achieved.
Can be achieved and within reach. Deals and the deal pipeline and what you make of the visibility that you currently have, and also the impact, for instance, of the BSNL deal, because that has been something that has caused a bit of consternation.
Like it's something we knew, right? Like the BSNL deal, like we have completed about 70% of the work. We are really proud of what's happened, and we will be completing it on time. And which means that that revenue stream has to be replaced with something else, and we will continue to look for opportunities to replace it with some other revenue stream.
But how confident do you feel about being able to offset that loss with a new revenue stream?
As I said, like I'm confident. That's the reason I said this year
it's going to be better.
Oh, we are quite confident.
So, Kriti, it's been a year and a half of you steering TCS through a difficult period and a period of great degree of uncertainty. What to your mind have been the big learnings, and more importantly, given the opportunities that you foresee, any changes in 25 that you intend to make?
See, there'll be always some small changes we continue to make. We learned in terms of, we've initially created we restructured the business groups, brought in more vertical focus, and that's been working well. And we created this AI.cloud unit. It's been working well, but we believe that cloud per se has a lot of headroom to grow. So we probably will put more focus on the cloud unit. So we continue to make small changes. And some focus areas like cyber security has been an important focus area. We believe that we have not really achieved the growth that we need to achieve. So that would be another focus area. So I would say there will be more small tweaks than big change that you should expect in next year.
In the next year. So the headline for 25?
Growth.
Growth and better growth than 24. That's K. Kritivasan of TCS taking us through the outlook for the year ahead, also concurring that 25 will be better, reiterating that quite firmly. Double-digit growth, not impossible or improbable, within reach. Small tweaks, not big changes, but the big story really coming in is that they believe that they will need to hire more, not less, in an AI-driven world. Kriti, always a pleasure. Many thanks for joining us. We'll take a break. There's plenty more coming up. Don't go anywhere. We're back in a moment with more.